Hello and welcome to another edition of 9 to 5 Live. I'm Mark Williams and joining me is Francois Savary. Hello, Francois.
Hello, Mark.
Nice to see you again and thank you for joining us. Last week at Jackson Hole, Jay Powell announced a new interest rate cycle. He very clearly announced that the Fed would be keen on reducing interest rates. Could you go through what Jay Powell said and what it means, please?
I would say that he was a bit cautious in terms of cycle. The first thing he said is, okay, it is time to cut rates. So clearly he reinforced the idea that there will be a rate cut by September, that the numbers and the fact that the labor market is slowing down, that the fight against inflation is going well, justified to change course and to lower interest rates. Nevertheless, he also mentioned that he will remain data dependent when it comes to the next move for the Fed. So it did not announce that they are going to go through a regular cycle of rate cut in September, November, December. He said, we are open to the idea to rate cut. We will judge by the numbers, but yes, condition seems to justify an easing cycle in the US.
When is the next rates decision? And bearing in mind what you've just said, what are you expecting from that?
I think that, I was always in the camp that 25 basis points is going to be the number in September. And as I said, it will also be dependent on the job numbers, job creation numbers that will be published just before the Fed, which happens on the 17th and 18th of September. So I think for the time being, I still consider that the 25 basis points is in the card for September. It's quite possible that they will act in November. I would add a November rate cut, but for the time being, I will be like the Fed. I will judge by the number.
A few commentators see Jay Powell's comments about him being less worried about inflation now and more concerned with supporting the economy and especially the jobs market. They see that as really, that's it, let's go. This is a new cycle of 25 bips every month or every 2 months. You're not in that camp.
No, I'm not yet in that camp. I believe that the inflation numbers, we will have the PCE number on Friday. I think that even if they say that they are very happy with the development on inflation, we need to be careful there, and it will be dependent on the ability of the Fed to really bring this inflation down, not significantly, but on a long-term basis. And again, I still defend the idea that we are not going to get back to 2% inflation very quickly. And that's the reason why I believe the Fed is going to act smoothly, and it will act dependent on the numbers.
Job creation numbers for 2024, they were revised downwards by 800,000 last week, I think. Was that a surprise to you? Secondly, Goldman Sachs sees a higher chance of recession in 2025 than they do, say, for 2024. What are your comments on those two things?
The numbers, the job creation number revision were quite significant. I think it was the highest in 15 years. So it tells you a lot about the fact that it was a big number. Nevertheless, when you look at the average monthly job creation, it remains very satisfactory. And it is completely in line with the idea that there is a soft landing scenario in the US. So that's one point concerning the job creation. The second point that we need to keep in mind is also that it is a very positive number in terms of productivity, because it will induce a revision in the rate of productivity growth in the US. And it means that if you have more productivity, the inflation risk is reduced. So you can see both sides. And in fact, I like this number. I think it's a positive number in the medium term. When it comes to recession in 2025, as you mentioned, I still doubt that you have the numbers to justify a call for a big probability of a recession in 2025. I really think that the numbers that come out from the US are still pointing towards a soft landing scenario. And as long as I have those numbers, I will not jump in the camp of high probability of recession in 25.
Let's turn to stock markets now and what all this means for us as investors. Stock markets are more or less in the US, in any case, more or less on their all-time highs or 1% away. Historically, a new rate cycle, and there's some doubt that you're telling me that this is really a new rate cycle. You're just seeing a few adjustments. A lot of commentators are saying a new rate cycle. They're calling it a pivot in the Fed's policy. Historically, a pivot is the worst time to start investing in the stock market. But this time it's different, or maybe it isn't. What are your thoughts on that?
First, I would say I believe in the pivot, but it's going to be a slow pivot. It's not going to be necessarily as quick as the market is expecting. That's my point. The second point about the fact that when there is a rate cycle easing, it's not necessarily good for the stock market. Usually rate cycle happen when you have a recession risk that is significant. If you do not believe in such a scenario and you believe that a soft landing is possible for the US economy, which is my case, I believe that then the conditions are completely different because it's very rare that you have a soft landing in the US economy. So you can have a rate cycle, easing rate cycle, and nevertheless, a stock market that is not going through a phase of correction.
What are your thoughts on future earnings per share in the US?
That's a big point. You still clearly, if you believe in soft landing, you believe that there is a slowdown in the US economy, and you need to be logical. It means that you need to be careful with your expectation for earnings in 2025. Is it logical to bet, as the consensus is doing, for double-digit growth in 2025 in EPS? I would be doubtful. I think that you need to be more cautious, and I think that high single digit is a better number for EPS in the US in 25.
I'll come back to a few more negatives now. The Dow Jones Transport Index is lagging the Dow Jones. According to Dow theory, would you follow that theory, and would that give you reason to be cautious in the next 6 months to a year?
It gives me a sign, technicals, you need to take them into account. It gives me a sign that there is something that is telling you once again that the US economy is slowing down. So it's a sign that is not only technical to my point of view, but it tells you something fundamental. The extent of the fact that the Dow Jones is lagging is the key issue. For the time being, it's not tumbling, so it's not telling you that you need to go away, sell and go away.
The market was remarkably broad-based in this recent. I'm not sure if it's a rally or a bounce. I'm not sure really how to describe it, because we spent such a short amount of time right at the bottom of that dip that I think maybe some technicians would call it a technical bounce rather than a rally. However, nevertheless, the market was broad-based in its rally. What are your thoughts on that, and what does that indicate for what kind of sectors we should be looking for? Depending, well, you're saying you're expecting a soft landing. Which sectors would you prioritize now?
First of all, I think that you need to consider different elements. First, the volumes on this bounce, as you call it, the volume on the market has been quite limited. So it tells you that's the first thing which induced me to say, okay, be cautious on this rally because low volume is not a good sign. Second, it tells you that a lot of people took opportunity buying ETF to get exposure to the market in general, and this is the reason why you had such a widespread rally and not focused on a few stocks this time. What does it tell me? It tells me that at the end of the day, until Labor Day, I don't want to make a big bet on the continuation of this rally, and I would stay on the sideline. I believe that you have no reason, as I said, to sell the market, but there is no reason for you to jump in and say, okay, I need to get in, fear of missing out. I believe don't do that. That's the first thing. Which sector? Again, I told you that we need to be diversified. I think that at one point there was, and we discussed it, there was no point in telling when there was a correction on the big seven that you need to sell them. I said you need to keep them. I still defend this idea. You need to try to defend. You need to position your portfolio where more in favor of stable growth. And I think that you should not avoid those stocks. I was very interested by the numbers that came out last week by Walmart and Target. Those numbers were good, and they are telling you that something is happening there. So you need to observe sector by sector. You need to be diversified, not make huge bets. And that's my positioning for the time being.
You make an interesting point about the fact that from your point of view, the rally was broad-based because people got into it using ETFs. Does that suggest to you that it's the retail market that jumped in rather than the institutions?
It tells me that the retail market wanted to get in because, for many years, for a few years in this market rally, in this bull market on the US equity, people have been on the back foot and they were not very positioned into equities. So each time there is an opportunity for the time being, the trend is that they purchase, they buy on weakness. This is still the mood of retail investor, and I think it was the case in this correction.
Okay, that's possibly a negative indicator. Coming to the dollar very quickly, chances of interest rate cuts. Some people saying 50 bips, and they're saying another 50 bips by the end of the year, by the way, as you know. Does this mean the dollar is a sell?
It depends. Again, against emerging currency, the dollar has been quite weak lately. Against the Japanese yen, which is below 144 this morning, it has been quite weak. So yes, the euro has been weak against the dollar, but most currencies, when you look at the dollar index, it is already softening and it is already on the downside. I think that globally, with an interest rate cycle possible and feasible in the US, I don't know the speed at which they are going to lower interest rate. I believe, yes, that the US dollar should be weaker in the coming months. I don't see it lose 15% or 10%, but this is, to my point of view, the positioning should be for a softer US dollar on the market.
Lastly, what does all this good news mean for European markets?
European market, you still have a lot of uncertainties. What is positive for European market? First of all, EPS expectations are very low on the European market. People have integrated a lot of bad news concerning Europe. So the earnings expectation are not a negative for the market. Second, in terms of valuation compared to the US, the market is attractive. But then there is a third point. You have economic uncertainty. Last week's number concerning Germany were not very reassuring. So that's the first element. You still have political uncertainty because the French situation. Normally, it's quite possible that by the end of this week, we should have a prime minister in France. So those elements are capping the ability of Europe to outperform the US. So in this context, and we discussed it over the last few months, I still believe that you need to have an exposure to Europe, but I would not be in a position to say you should overweight Europe compared to the US in the current situation.
Francois, that's lovely. I think that's all we've got time for. Thank you very much indeed. Speak to you next week.
Bye-bye.
Bye-bye.